Right. We bought basically short $8.4 billion of credit default swaps related to mortgages or financial companies.
You must have been pretty confident that this thing was going to blow up.
Well, we had a giant bet for us, and I was extremely confident in the outcome.
Were your investors as confident?
I know for sure that some of them thought I lost my mind.
So you made a ton of money?
Made a ton of money. Much more than I ever imagined, I'd ever have.
Michael Burry, one of the few men who foresaw the housing bubble in the United States in the early 2000s. The man who made over $800 million by purchasing credit default swaps. The man who earned a spot in Michael Lewis's book, The Big Short, and was portrayed by Christian Bale in the film Adaptation. An interesting anecdote is that at the end of the movie about Michael Burry, it mentions that he no longer invests and instead focuses on a single commodity, water. While that line in the movie did not hold up over time at all, as 7 years later, Michael Burry has well and truly returned to the world of investing and even reopened his fund, Scion Asset Management, which emerged from the remains of Scion Capital, which you see portrayed in the movie. If you're not closely following the stock market, you may not know that despite the lack of interviews or public appearances from Michael Burry in 2021 and 2022, it was still possible for quick investors to follow his thoughts and opinions on the stock market through his Twitter profile, if you were fast enough to catch his tweets before they were deleted, something Burry is notorious for. While Michael Burry is again confident heading into 2023 with another clear-cut prediction for how he thinks markets are going to play out and exactly how investors should be looking to position their portfolios to make a ton of money in 2023. And a warning to investors, his predictions are as sinister as ever, with Burry predicting a huge recession to continue to play out in 2023. Here, in a nutshell, is how Burry believes 2023 will play out for investors. What strategy will pull us out of this real recession? What forces would pull us so? There are none. So we are really looking at an extended multi-year recession. Who is predicting this? There are none. So Burry, in true Michael Burry fashion, is standing by a contrarian investing standpoint and believes that we are looking at an extended multi-year recession. In this video, what I will do is provide a summary of Michael Burry's recent insights on investing, inflation, and the state of the markets in an effort to understand his advice and message for the coming year of 2023. We will also look at how Burry is personally positioning his portfolio to make the most of a bad investment climate and inevitable recession come 2023. Before we jump into the video, only a small percentage of my viewers are actually subscribed. If you enjoy daily finance content, consider subscribing or liking the video. It's free and you can always change your mind. First things first, let's jump right into it and address the elephant in the room, inflation. And Burry has some extremely polarizing views when it comes to inflation and how it will affect markets in 2023. Looking back on Michael Burry's inflation prediction for 2022, he was a big believer that we were going to get crunched by inflation in the year ahead, and as is common the case, he was spot on in that prediction. Burry tweeted out in 2021, the US government is inviting inflation with trillions of money printing plus reopening boosting demand as employee and supply chain costs skyrocket. And as we saw play out in 2022, inflation was way higher than markets predicted, which caused the Federal Reserve to go extremely hard on monetary tightening and raising interest rates at an unprecedented speed, which had the effect of wrecking asset prices and stock markets globally. And for 2023, Michael Burry doesn't think the pain is over. Burry believes that markets have not yet bottomed because he believes we're going to see another huge spike in inflation like we saw in 1929 and the 1940s. Predicting for 2023, Burry tweeted, "Inflation appears in spikes. When the spike is resolving, it won't be because of Biden or Powell, it will be because that is the essence and nature of inflation. It resolves, fools people, and then comes back. When it comes back, neither the President of the United States nor the Federal Reserve will take credit." And the charts back up Burry completely. They show that since 1940, inflation does not occur once but usually spikes twice before resolving. This isn't a trend that has only been spotted by Burry either. Tech billionaire and investor Chamath Palihapitiya has spotted this and spoke on how the sharpest minds on Wall Street are expecting this exact scenario to play out in 2023. So a double spike in inflation causing more downwards pressure on markets and forcing the hand of the Fed to continue to raise interest rates and tighten their monetary policy is Burry's prediction for 2023, which can only mean one thing: lower equity prices and a lower stock market. Now, this leads us on to Burry's second prediction for 2023, continued interest rate rises from the Federal Reserve to battle the sky-high inflation. Although inflation does currently look like it's coming down and the Fed is hinting that it will pivot in the first quarter of 2023, as we covered before, Burry believes that inflation will slow, causing the Fed to reverse course and cut interest rates, only for inflation to peak harder and cause the Fed to have to continue raising interest rates. Burry tweeted about this after Business Insider covered his initial prediction that inflation will slow only to double peak. You heard it here first, or second, or third. And Burry's third prediction going into 2023 is that any market rallies we see in markets are going to fool investors into thinking the bottom is in. In a tweet, Michael Burry warned that dead cat bounces are the most epic and can easily deceive investors into thinking that the bottom is in. 12 of the top 20 Nasdaq one-day rallies happened during the 78% drop from the 2000s top. 9 of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top. He also shares the Dow had 10 bear market rallies over 10% and averaging 22.8% before going on to bottom a further 89% down. Therefore, he's suggesting that investors should not be fooled. It will take some time before hitting the true bottom of this current downturn. But what is Burry personally watching to judge whether markets have truly bottomed or not? Well, Burry has also shared the indicators he is watching closely. The first indicator is the reading of the VIX, which refers to the stock market's volatility index. The higher the VIX, the more volatile the market, and vice versa. Historically speaking, there has been no bear market bottom without a VIX reading of 45 or more. And recent history has proved this rule as well, with the market not bottoming until huge spikes in the VIX was observed, with readings of 70 in the 2008 crash and then hitting 65 during the COVID crash in March of 2020. In 2022, we have not seen this huge shoot up in the VIX or volatility, meaning that historically speaking, it's very likely we haven't seen the bottom yet. The second indicator that Burry is watching closely is valuations of companies. In a tweet, Burry points out that 13% of stocks have closed above their 200-day moving average, which is never usually seen at the absolute bottom. The bottom typically occurs when the number is closer to 2%. At the bottom in 2008, it was 1.2%, and during the crash in 2020, it was at 2.8%. Therefore, according to this metric, we currently still have a fair way to go before reaching the true bottom of markets. Now, the third and final indicator Burry is looking at to determine the bottom of markets is the amount of unprofitable companies on the stock market and their sky-high valuations. Currently on the US stock market, there are 218 companies with a valuation of over $1 billion that are losing $100 million annually. Additionally, there are 29 companies with a market cap of $10 billion that are losing $100 million annually. These companies include Uber, Snowflake, Lucid, Rivian, and Shopify, among other dozens of companies. Burry points out in a tweet that before we see the absolute bottom in markets, the silliness in terms of sky-high valuations and unprofitable companies has to go. Okay, so we've determined that Burry doesn't believe that markets have bottomed and will continue downwards in 2023 due to a double spike in inflation, further tightening from the Federal Reserve, and increased interest rates. But how is he personally positioning his portfolio to weather the storm and make the most of a bad situation? Well, Burry in a tweet likened the current investing climate to a similar scenario he witnessed play out in 2000, giving a clue to how he is personally investing. Another feeling I'm getting is mid-late 2000, free cash flow totally on sale and ignored while former momentum stocks are coming down but not far enough, and darling better businesses still had a ways to fall. Value was about to take off for years despite more crash on the way. So Burry is suggesting that boring businesses are the ones that will actually outperform in 2023, which is also backed up by his current holdings as disclosed in his most recent 13F filing. Within the 13F filing, a document which must be submitted to the SEC quarterly and reveals an investor's holdings, it was disclosed that Burry's portfolio has been heavily focused on essential services such as prisons and telecom companies. Currently, 2/3 of Burry's total portfolio consists of these real asset companies, whereas in the past it was heavily concentrated in non-essential service companies like Meta or Cigna. It is clear that Burry's significant shift in portfolio is due to his belief that non-essential products and services will continue to decline in value in 2023, while value companies and essential service companies that support the basic functioning of society will become more valuable or at the very least maintain their value. Typically, in a recession or prolonged bear market, people's spending habits shift, resulting in less money being spent on non-essential goods and services. This is why technology companies have been particularly hard hit in 2022 and have already begun experiencing mass layoffs, with hundreds of thousands of employees being fired. But no matter how bad the economy gets, there are services society society will always need to continue to function, things like energy infrastructure, social services, and prisons, which is why Burry has positioned his portfolio into these types of companies. So there you have it, more doom and gloom on the way as predicted by Burry for 2023. However, he has laid out the blueprint on how to invest in recessions and where to best concentrate your capital. Overall, the main focus for investors in 2023 should be on finding ways to increase their income as much as possible in the next 12 to 24 months. This way, even if the market continues to decline, they will have sufficient cash on hand to take advantage of lower prices no matter the assets they decide to invest in. Anyway guys, hope you enjoyed today's coverage of Michael Burry. If you enjoyed the video, consider subscribing or leaving a like, it would be greatly appreciated. Leave a comment on what investor you would like covered next, and as always, all the best.